The Federal Reserve finally got interested in the credit card reward system. So interested that they mapped it in unprecedented detail. What they found is a vast network of 238 million American cards operating a predatory $15.1 billion redistribution system. 90% of all credit card spending now happens on rewards cards. You swipe your card for coffee, earn some cash back, and move on. But you're paying for someone else's benefits, and you're actually losing money. On the other hand, some cardholders gain each year from this system. How so? And no, this isn't about rich versus poor. The pattern holds across every income bracket. Banks, merchants, regulators, you, me, we're all part of a system where the rules aren't written down anywhere. So state regulators are starting to ask questions. Consumer groups are demanding answers. The credit card industry is spending millions on lobbying to prevent changes that could collapse their beloved business model. And banks are preparing for a regulatory earthquake that could reshape how Americans pay for everything. Here at BlackLine, we help companies automate their finance and accounting processes. We're interested in how technology can improve people's finances. And I can tell you that the reward system has had its impact and that it needs to change. Credit card rewards began as a straightforward business solution that gradually evolved into something much more complex. In 1984, American Express was facing a problem. Their most valuable customers, business travelers spending thousands monthly, were switching to cheaper competitors. Amex needed a way to retain these high spenders without cutting their fees. Their solution was membership rewards, the first modern points program. Spend money, earn points, redeem for flights and hotels. Simple loyalty marketing for a premium customer base. For nearly a decade, this model worked exactly as intended. Rewards remained exclusive to affluent customers willing to pay annual fees of $100 or more. The economics were clean. Charge high fees, offer valuable perks, keep your best customers happy. Then, Discover disrupted everything in 1986 with the first mass-market cashback card. 1% back on all purchases. No annual fee, available to anyone with decent credit. They were essentially giving away money to attract customers from established banks. This forced every major player to respond. Chase launched rewards cards in 1994. Citibank added cashback options. Capital One introduced airline miles programs. What looked like healthy competition was actually creating the foundation for today's problems. The real transformation happened in the 2000s when technology changed how banks understood their customers. Credit scoring algorithms became sophisticated enough to predict not just who would default, but who would carry balances, who would pay in full monthly, and crucially, who would be profitable over time. This predictive capability allowed banks to do something revolutionary. Offer the same product to different people while knowing with near certainty which customers would make them money and which would lose them money. The 2008 financial crisis accelerated this divide by creating two distinct consumer behaviors. One group became hyper-focused on financial optimization, learning to maximize rewards while avoiding all fees and interest charges. They turned credit cards into profit extraction tools. The other group, facing economic pressure, started using credit cards for necessities rather than convenience. They carried balances, paid interest, and unknowingly became the funding source for everyone else's rewards. Banks noticed this split and designed their products accordingly. Premium cards for the optimizers. High annual fees but generous rewards for people who would never pay interest. Basic cards for everyone else. Modest rewards but profitable when balances were carried. By 2010, the cross-subsidy model was fully operational. Banks could afford to lose money on customers who maximized rewards because those losses were covered by profits from customers who paid interest. This was simply how economics had to work. To offer meaningful rewards, banks needed revenue. That revenue came from interchange fees and interest payments. The customers generating the most revenue naturally subsidized the customers generating the least. Corporate adoption supercharged the system's growth. Businesses discovered they could process enormous transaction volumes through rewards cards while maintaining the same cash flow they'd always used. A company spending $1 million annually could earn $20,000 in rewards while facing no personal liability if things went wrong. The Federal Reserve study traced this evolution precisely. What started as American Express trying to retain business travelers had become a system where 238 million cards redistribute $15.1 billion annually based on financial sophistication rather than economic need. The system reached its current scale through pure market forces, competition between banks, advancing technology, and changing consumer behavior. Each step seemed logical at the time. The cumulative effect created something entirely different from what anyone originally intended. This evolution happened gradually over 40 years. That's why most participants don't actually understand the system they're a part of. So let me break it down for you. The Federal Reserve study says intelligent, well-educated people consistently make credit card decisions that cost them money. Understanding why requires looking at how your brain processes financial information. Indeed, we all have mental shortcuts that create predictable vulnerabilities, and credit card companies built their entire business model around them. The most fundamental bias is mental accounting. Your brain treats money differently depending on how it's categorized. When you earn 2% cash back, your brain files this under rewards or savings. When you pay 25% interest on a carried balance, your brain files this under debt or mistakes. These feel like separate financial events even when they're mathematically connected. The cashback feels like smart money management. The interest feels like punishment for poor planning. But mathematically, they're part of the same system. Your interest payments fund other people's rewards. This mental separation becomes stronger due to timing differences. Rewards appear on your account within days and feel immediately gratifying. Interest charges appear weeks later on statements you might not examine closely. Your brain treats immediate rewards and delayed costs as largely unrelated. The spending effect makes this worse. Multiple studies show that rewards cards increase spending by 12 to 18% compared to cash, even when controlling for convenience factors. The promise of rewards creates psychological permission to spend more. You're not getting free money for purchases you were already making. You're being incentivized to make additional purchases that generate more fees for banks and potentially more debt for you. The most costly bias is the balance matching heuristic. When you have multiple credit cards with balances, you instinctively put extra payments toward the card with the highest balance, not the highest interest rate. Say you have $500 on one card at 29% interest and $1,000 on another at 15% interest. You have an extra $100 to put toward debt. Most people choose the $1,000 balance because it looks like the bigger problem. But every dollar you pay towards the 29% card saves you 29 cents in annual interest. Every dollar toward the 15% card only saves 15 cents. You're literally choosing to pay more interest because the math doesn't feel intuitive. This bias costs you money on any debt. But rewards cards make it worse. Higher rewards lead to higher spending, which creates higher balances. Those higher balances draw your attention and payments. Even rewards cards often carry some of the highest interest rates in your wallet. The Federal Reserve data shows the brutal effectiveness of these psychological mechanisms. Customers with credit scores below 660 lose an average of $5.40 monthly on rewards cards compared to regular cards. They earn rewards, but they pay substantially more in interest and fees. Customers with credit scores above 780 gain an average of $16 monthly. Same cards, same stores, completely opposite outcomes based purely on behavioral patterns. This isn't about intelligence or income. The Fed study controlled for both factors and found that within every income level, some users profit while others subsidize. High-income people who don't understand these psychological traps still lose money to middle-income people who do. Temporal discounting amplifies every other bias. Your brain heavily weights immediate benefits over future costs. The 2% cash back you earn today feels more valuable than the 25% annual interest you might pay later, even when simple math shows that avoiding the interest is far more valuable. The sophistication gap creates the redistribution. Sophisticated users understand these psychological traps and systematically avoid them. They use rewards cards like charge cards, paying balances immediately and treating rewards as profit extracted from other people's behavioral mistakes. Naive users fall into multiple traps simultaneously. They increase spending for rewards, carry balances, make payments based on balance size rather than interest rates, and subsidize everyone else's optimization. Credit card companies understand these biases better than their customers understand themselves. They've spent billions studying consumer psychology and designing products that systematically exploit predictable behavioral patterns. The $15.1 billion redistribution flows predictably from people who make psychologically natural but mathematically suboptimal decisions to people who make psychologically difficult but mathematically optimal decisions. Understanding these biases is crucial because changing individual behavior, while important, won't eliminate the systemic redistribution because the business model institutionalizes it. To understand how $15.1 billion gets redistributed annually, you need to understand the economic engine that powers the entire rewards ecosystem. Every time you swipe a credit card, the merchant pays a fee to process that transaction. This fee gets divided between the card network like Visa, the bank that handles the merchant's account, and the bank that issued your card. In the United States, these interchange fees average 2 to 3% of every transaction. Buy a $100 item with your credit card, and the merchant pays about $2.50 in processing fees. This creates an enormous pool of money. Trillions in annual credit card volume generate hundreds of billions in interchange fees. Here's where geography becomes crucial. European regulators cap interchange fees at 0.3% through the interchange fee regulation. That same $100 purchase that costs the merchant $2.50 in America costs only 30 cents in Europe. The American system extracts 8 times more money from each transaction than the European system. This explains why American credit cards can offer generous cash back and travel rewards, while European cards offer almost nothing. But there's another layer most people never consider. Every business in America is forced to participate in funding your rewards, whether they benefit or not. Card networks enforce something called the Honor All Cards rule. Accept Visa? You must accept all Visa cards, the basic ones and the premium rewards cards that cost 3 times more to process. Companies like Target, Amazon, and Home Depot are fighting this rule in court, but small businesses have no choice. So businesses do what they always do with costs. They pass them to everyone. A Federal Reserve study found that all customers pay higher prices to subsidize credit card rewards, even people who pay cash. Your grandmother paying cash for groceries is subsidizing someone else's business class flight to Tokyo. This creates another redistribution layer based on business size. Small businesses pay the same interchange rates as large corporations, but corporations get premium cards with better rewards and corporate liability protection. The corner store funds the system, but can't access the benefits like Fortune 500 companies. This business funding creates the revenue pool that banks distribute through 3 primary revenue streams. Interchange fees provide steady income on every transaction, regardless of whether customers pay interest. Interest payments from customers who carry balances create high-margin recurring revenue. Annual fees generate upfront cash from customers willing to pay for premium benefits. The reward system deliberately creates a cross-subsidy between these revenue streams. Banks can afford to pay generous rewards to customers who never pay interest because those rewards are funded by customers who do pay substantial interest. This cross-subsidy model requires mathematical precision. The Federal Reserve study found that banks need approximately 40% of cardholders to carry balances and pay interest to subsidize rewards for the 60% who pay in full monthly. The system works because different customer segments have predictably different behaviors. Banks can predict with remarkable accuracy which customers will fall into which category using credit scores, income data, and spending patterns. Corporate credit cards operate under different economics that amplify these advantages. Business cards are exempt from many consumer protection regulations, allowing banks to charge higher interchange fees and offer more generous reward structures. The liability structure creates additional benefits. When businesses apply, the company assumes debt obligation, not the individual, dramatically reducing default risk and enabling more favorable terms. American Express demonstrates how regulatory structure creates competitive advantages. unlike Visa and MasterCard, which operate with separate card issuers and processors. American Express functions as both issuer and processor. This integrated model allows Amex to capture revenue from both sides of every transaction and exempts them from interchange fee regulations that cap Visa and MasterCard fees. When European regulators imposed 0.3% caps on Visa and MasterCard, American Express continued charging merchants 2 to 3% because their model wasn't covered by the regulation. This is why Amex cards offer the most generous rewards in Europe, while traditional bank cards offer minimal benefits. The business model creates perverse incentives throughout the system. Banks profit when customers make behavioral mistakes, carry balances, and pay interest. They lose money on customers who optimize rewards and pay balances in full. Banks have essentially built a machine that extracts maximum profit from information asymmetries, behavioral biases, and regulatory arbitrage. And finally, regulators are coming after it. The Federal Reserve study provided ammunition for a regulatory battle that could reshape American payments. State-level action is already happening. California's legislature is actively considering interchange fee caps that would limit banks to the same 0.3% that European regulations impose. New York's Attorney General has launched a formal investigation into credit card industry practices. Illinois and Massachusetts are reviewing similar regulatory proposals. These aren't just political gestures. If large states like California implement interchange caps, they could force nationwide changes through economic pressure. Banks can't feasibly operate different fee structures for different states, so state-level regulations often become de facto national standards. The regulatory momentum builds on successful European precedent. When the EU implemented its interchange fee regulation in 2015, it successfully reduced interchange fees from 0.8 to 1.6% down to 0.3% without collapsing the payment system. European consumers lost most rewards benefits, but merchants saved billions in processing costs that theoretically could be passed to consumers through lower prices. American regulators are studying whether similar changes would benefit the overall economy. The Federal Reserve study provides data for both sides of this debate. Consumer advocacy groups point to the regressive wealth transfer as evidence that the current system exploits behavioral biases to redistribute money from less sophisticated to more sophisticated users. They argue that any financial system creating $15.1 billion in redistribution based on psychological manipulation rather than economic value needs regulatory intervention. The credit card industry counters that rewards provide genuine consumer benefits and drive innovation in payments technology. They argue that European-style caps would eliminate consumer benefits without necessarily reducing retail prices, since merchants might pocket their savings rather than passing them through to customers. Both sides are preparing for an extended political battle. The industry is spending millions annually on lobbying to prevent regulatory changes that would eliminate their most profitable business model. Consumer groups are organizing coalitions to push for European-style reforms that would make the system more equitable. State and federal regulators are studying multiple intervention options beyond simple interchange caps. They might require better disclosure of how redistribution works so consumers can make more informed decisions. They could target specific practices like balance matching exploitation through clear payment allocation requirements. International competitive pressure could accelerate American regulatory changes. If other major economies follow Europe's lead on interchange regulation, American banks might face disadvantages in global markets that force domestic policy changes. Technology companies are positioning themselves to benefit from either regulatory outcome. Digital wallet providers, cryptocurrency payment systems, and embedded finance platforms could all gain market share if traditional credit card economics become less attractive due to regulation. Banks are also preparing for potential changes by developing alternative business models that depend less on interchange revenue. Some are exploring direct consumer subscription fees for premium rewards programs. Others are investing in services like financial management tools that could generate revenue without depending on merchant government-funded interchange. The most likely scenarios involve gradual change rather than sudden disruption. Regulators might phase in interchange caps over several years to give the industry time to adjust. They might implement hybrid systems that cap fees for small businesses while allowing higher rates for large merchants. They could also focus on transparency rather than price controls, requiring banks to clearly disclose how much each customer contributes to or benefits from the redistribution system. Whatever regulatory changes emerge, they'll determine whether America maintains its unique rewards-rich credit card system or joins most of the world in offering minimal rewards funded by much lower interchange fees. Talking about hidden fees and cynical business models, do you actually know what happens when you use buy now, pay later? If you don't, have a look at this video.